One of the most common complaints we'll hear from investors is simply that everything's going up and they're not going up as fast as everything else. And to that, we'll have to remind them that they don't have whatever is going up 100%. Right now, for example, in 2023 into 24, that thing that was going up was stocks, and investors that had bonds or cash were underperforming. And in other years, when bonds were kicking butt, people wanted just bonds. So it's important to remember that diversification works even though it doesn't always feel good. As we're looking at this chart, there's three essential things that can happen when you have a diversified portfolio. One, you can still lose money. A lot of people think diversification means never losing money, but diversification really means you always have to apologize about something in the portfolio. So when the portfolio is going down 40% or the equity markets are down 40%, a diversified portfolio in this case was down 15%. Nobody's excited to be down 15% just because somebody else is down 40. Their first thought is, if I was in cash, I wouldn't have lost anything at all. And then you have scenarios where the market or the stock market's going screaming higher, and you think, if I had just the stock market, I would be doing a lot better. And so the temptation is to abandon your strategy to go on the stock market. Obviously, this is problematic because once you've seen those numbers and you're chasing the returns, the stock market is already higher and you miss those returns that you're so excited to get. And then you have the limited number of cases where diversification actually works on a short-term basis, where having a combination of stocks and bonds actually serves us better than just having stocks by themselves. So it can happen, but it is the rare case. But the most important thing is, as we apply those things over the long term, we see that diversification actually does work. And this is particularly true for retirees and other people that need to take money from their portfolio. Because again, it's nice to have a stock portfolio that goes up from point A to point B or has some limited amount of dividends along the way. But if you are going to be spending money from your portfolio and drawing down your principal, you need to be in a spot where you're never forced to sell stocks when they're down. The only way to do that is to have something besides stocks that you can draw from. And having those things in such a quantity as you can ride out a drawdown for an extended period of time. So again, keep this in mind that diversification works even though it doesn't always feel good. And so stick with the plan even when it appears that you're underperforming, because in the long run, sticking with the plan is the one thing that is going to continue to work. So if you have a question about this or anything else, just let us know.